Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como. Today is the 18th of August. It has been a hot minute since we were able to make a video. We took some holidays last week, and because, always Murphy's Law, we always tend to get the busiest weeks when we decide to go away to get some R&R. I was definitely out of internet and cell range, which was quite relaxing. I actually did quite a bit of reading over the last little week, books that had been stacking up on my desk. But let's get into what the markets look like today, and then we'll talk a little bit about what's happened over the last couple of weeks and how that's still playing out today as the dust settles after a lot of the news last week. All right, canola was down $9.20 today, settling at 651.70 on the November. Minneapolis wheat was down a cent at 588 and a quarter. Kansas wheat was down 3/4 of a cent at 506 and a quarter. Chicago wheat down three and 3 3/4 at 502.75. Beans were down 1 1/4 today at 1041 and a quarter. Soybean oil was down 9 points today at 53.32. Corn was down 1 1/4 cents today at 406.50. Canadian dollar traded marginally higher today. It's trading now at 72.41. Live cattle were up to 231 a hundredweight, and feeder cattle were up as well, $3.50 a hundredweight to 350.92. All right, let's get into some of the headlines. Not that I want to be, late to the party or anything, but of course, this headline was something that came across the tape last week. China slapping temporary duties on Canadian canola. What essentially happened here was that China slapped a provisional 75.8% anti-dumping duty on Canadian canola seed, which was effective August 14th, so a few days ago already. This of course follows the earlier tariffs on canola oil, canola meal, and related products, essentially closing the door on Canadian canola products and canola seed. Originally the canola futures plunged down to about $630. They recovered that day up to about $650. So we're not that far off where the close was after the big movement. I do want to talk a little bit here about market manipulation. I've been hearing a lot of people say that China has done this in order to buy lower priced canola. I want to dispel that. That's not really true. Yes, it is true that China does wait to buy a lot of commodities until harvest pressure, times purchases that lines up with gluts of supply and that kind of thing. They do sometimes cancel vessels, mostly out of the US. They do use their size as leverage, but that is not what happened here. And that's not why they're putting tariffs on our canola at this point. Market manipulation implies some strategic distortion, like rumor campaigns or engineered cancellations to push prices down, before buying back in. Here China isn't really setting a trap. It's deliberately shutting out Canada for political and trade reasons. The yes, the price drop effect is real, but it is more a side effect of the tariffs and trade policy, not a ploy in order to offer a better buy later. It's more like slamming the door shut than tilting the playing field. These tariffs are probably a long time comings. Canada slapped duties on Chinese electric vehicles, steel, and aluminum back in October. China did respond in spring with duties on the oil and meal side of the canola. But what's happening right now has little to do with canola per se. There's some net desired price, or the net desired price of canola from China. It's a lever that's being pulled to remove other trade barriers that Ottawa had put on them earlier, not necessarily a purposeful hit on canola prices in order to buy back at cheaper values. One of the reasons what we kind of can see this, that there isn't market manipulation happening. China did book a cargo of canola from Australia today. This was the first purchase of Australian canola by China since 2020. After that, Australia was locked out of the Chinese market due to phytosanitary conditions, and those weren't resolved until recently. So, all of these kind of dominoes have been lining up as far as Canada placing tariffs on EVs and some metals, and then China and Australia amending trade fences. China wants us to take the barriers off of those products. So they're not really waiting for lower prices. They are actively out in the market looking to replace Canadian canola, and this may actually be causing the price of international canola to move higher as they replace short-term Canadian canola with other sources. Obviously, countries like Australia and European Union and other large rapeseed canola producers, they had their markets even without China. So now China is going to be going back into those markets and looking to secure some supply after they locked out Canada, and those prices are just going to rise. So I do not believe this is a ploy by China to get better access to canola prices. One thing I do want to point out here in the charts is, yes, on the day that the tariff news was announced, um, we did see a sharp decline. We have not recovered from those sharp declines. Obviously, if we're going to peel, 5 million tons of demand out of Canada, that's going to have an effect on the canola. But based on that number, how much of our export program, that's nearly half of our export program, if not more of our half of our export program, the damage should have been significantly higher here. What we did have happen is we saw the market sink, about $50 a ton, or it went close to record, or not record low, but um, to the limit down, but recovered through much of the day. Since then, it's been trading over that 20-day moving average. And maybe I'll use a pen here. This kind of area here is very interesting to watch because, we obviously staved off, keeping canola under the 200-day moving average on the day the announcement was made, and it's kind of been trudging along that 200-day moving average as we see now. So there still is some support under canola. This wasn't a massive reduction in canola, values uh, per se. As you can see here, we were trading 665. We'd hit before the announcement a number of times, and today we're hovering around 655. It closed at 652. So 665 to 650. We're talking 10, $12. That's one day's trading range in even without the China news. So I don't really think that this has had as much of a dramatic impact as what it looks like, at least in the futures market. So just kind of wanted to alleviate some of those fears. Not to say that this is not a bad thing for Canadian canola, it absolutely is. But having it done this early in the crop year actually gives uh, us a lot of opportunity to sell canola to elsewhere other than China. China cannot, also, I should mention, China cannot do without Canadian canola. So either they're looking to make a resolution and use this as a lever to pressure our government significantly so that this gets taken off, or they will have to import some canola. They may grant some exception waivers and things like that for importers to get some canola in there. They will buy some canola from us in the next 12 months. I could guarantee that, or I guess I can't guarantee anything, but they can't go out and source it from other sources completely. Australia does not have enough. The EU is not set up to do it properly either. They will need to come to us for canola. So that either means a resolution of the issue or some temporary waivers, or maybe even um, Chinese buyers paying the tariff. So there will be some canola that does flow after this date to China. It's just a matter of how and when that will happen. Another thing I wanted to touch on was, you may have seen this headline: importers struggle to resell Canadian canola meal caught in China tariff. Now, it's funny, when this crossed my tape, I was like, well, this is not new news, right? But it was published on August the 14th, which was the day that the tariff announcements were made as well. Um, but I think this is pretty much old news. The tariffs on meal were placed in March. This buildup of canola meal stocks in the warehouses is not a new thing. It's not like those 400,000 tons landed there after the announcement was made. These have been sitting there for some time now. But I think what's happening and why this is making headlines right now is because uh, the Chinese were maybe waiting until some tariff resolution on meal and oil before they imported it from, the um, the pre-customs storage into the country. We're hoping to avoid some of the tariffs on those products are 100%. But now I think they're losing faith, and that's going to happen. And so now they're looking at maybe offloading it off the shores of China into other destinations. Hence why this is making headlines today. Otherwise, I think this is relatively old news. All right, getting on to some of the other commodities. The other, big upset, I guess you could call it, in last week's news was the USDA report reporting 188.8 bushels per acre of yield of U.S. corn. Absolute monster of a crop, according to the USDA. The average trade guess was 184. 180.2, I think it was. The previous was 181.1, so it was like 7.7 bushels per acre above last month's assessment, which was just huge. That did have an impact on corn. As you can see, it pushed December corn, well below the $4 mark. However, it has recovered since then, back up to the 20-day moving average now. I think we're at a pretty pivotal point here. If we can, either corn is going to fail to break above the 20-day moving average and then continue its trajectory lower. But if it does move higher, that may mean that, a lot of these big yield hypes are priced in, or, many may feel that the USDA overshot the landing a little bit, and we'll need to scale that yield back. Of course, the pro farmer crop tour started today. We'll see some results as the week goes on about that tour. That usually comes in lower yield than the USDA does, and markets tend to factor that in. So we're at a point now where, maybe the most bearish news has been released by the USDA, and they may need to claw that back. As time goes on, 188.8 is just a monster yield. It's hard to imagine that with the increase in acres, the kind of fringe areas where the acres increase for corn would see that much of a yield increase without being in the core area. But I guess we'll see. This test of the 20-day moving average, I think, is important. If we can break above it, that may signal that there is some rebound available for the corn market. Wheat continues to slide. Part of this, I would say, is because of corn. Corn being weak has kind of had a ripple effect on wheat as a feedstock. And, the world is just not looking for wheat at this time. The world is flush of wheat at this time. Wheat buyers love to live hand to mouth because wheat is essentially being harvested somewhere in the world, somewhere like 11 out of 12 months of the year. So it's not like there is, no supply coming for the next few months or anything. In fact, we're probably more flushed than ever at this point for wheat. So, we patiently wait for this as well. Our spring marketing efforts cover the time period where we need to get through harvest and the cash flow needs and bin space needs there. So, if that's still a concern for you, if you haven't done any spring marketing, drop us a comment. We can maybe help you through some strategies around that if you do need to take action in this lower seasonal market prior to harvest. Moving on to soybeans here, we did see some rebound in soybeans after the USDA report as well. We're back, above 1040 now. We've traded basically above 1040 for the last 4 days or so, which is good, as prices had sunk down to about 980 or a little bit higher than 980. We did break a bunch of technical signals here as far as trend lines, moving averages, and all of that jazz. We beat the previous high. We haven't tested the 1060 high from June or July 1st or 2nd, and so this market still looks technically positive now, which is a big swing from just a week or more ago. Some things to consider here. This is just a snapshot of the USDA WASD. One of the things that was kind of a big surprise here was the reduction in ending stocks in the US from 310 to 290. So that's significant, even though yield, as you can see, went up from 52.5 to 53.6. However, again, we saw production actually move lower. And again, because of the harvested and planted acreage amendments. So why we saw that big jump in soybeans was largely because of the change in fundamentals. This is a pretty big change in fundamentals for soybeans, particularly the area planted and harvested here. So lower production overall, which means lower ending stocks. That was a bit of a surprise to the market and why we're seeing soybeans rally higher. Just also a note on the world stage, we did see ending stocks loosen or tighten up a little bit as well from 126 to 124.9. That doesn't seem like a lot. Of course, a big chunk of that was the US, but we did see some changes as well in the EU here, small changes, and Argentina. Where did I see that? Nope, maybe it wasn't Argentina. Oh yeah, little changes here in Argentina as well, 300,000 tons or so. So little changes made on the USDA world stage on soybeans, but some big changes made in the USDA on the domestic side. So that's rallying soybeans, which is great. We like to see that. It was under pressure for a very long time. All right, this is just a quick snapshot of what we have to offer to our clients. If you want to get onto our premium subscriber list, go to canadianagmarkets.com/subscribe. Hit the subscribe button there. It's only 99 bucks a month. You can cancel anytime. And yeah, thanks for joining us. We will see you again tomorrow.